The world of high finance is screaming, but most people are looking at the wrong charts. Welcome back to Faultline Finance Channel. We are witnessing the most violent paper market flush in the history of precious metals. Just 8 weeks ago, in January, gold defied every critic on the planet by screaming to an all-time high of $5,603. It was the ultimate inflation hedge victory lap. But then, the trap door opened. If you are watching the headlines, you see a sell-off. If you are watching the data, you see a calculated liquidation. We are currently seeing gold hit what we call the floor. But to understand where we are going, you have to understand why it's falling. Why is everyone in the institutional space whispering about $4,300? That is the line in the sand. The 0.618 retracement sits exactly at $4,528. This is where paper hands get shaken out. And the diamond hands of central banks, specifically in the East, start their massive accumulation. This isn't a crash. It is a retest of reality. But here's the massive why. Why is gold dropping while oil is threatening to ignite? While the market was begging for a pivot, the Federal Reserve has remained cold and calculated, holding rates steady at restrictive levels. By refusing to cut, the Fed has effectively weaponized the US dollar, creating a liquidity vacuum for bullion. You have an energy crisis brewing in the Strait of Hormuz, fertilizer costs moving vertically, and yet gold is being sold off. It is a classic dash for cash before the real storm hits. The paper market is being flushed so the physical market can reset. Stick with me, because the oil numbers we are about to discuss are going to change everything you thought you knew about the 2026 economy. While gold is finding its floor, the energy market is hitting a vertical wall. To understand the chaos of March 2026, we have to look back exactly 25 days to February 28th. That was the morning the geopolitical landscape fractured. Operation Epic Fury, the massive coordinated US and Israeli campaign against Iranian infrastructure, didn't just degrade military targets, it ignited the world's most sensitive maritime jugular. In immediate retaliation, the Strait of Hormuz was effectively shuttered. We aren't just talking about a minor shipping delay here. We are talking about the primary artery for 20% of the world's daily oil consumption being clamped shut. The physical market is already showing the scars. While paper futures are volatile, the price of physical wet barrels is screaming. Refiners in Asia are currently paying record premiums just to secure any cargo that isn't trapped behind the Persian Gulf blockade. This is what the International Energy Agency is officially calling the biggest oil supply shock in history. We have moved past the era of $80 stability. On March 12th, Brent crude briefly touched $100 a barrel, and the momentum hasn't stopped. But the real story isn't the $100 mark, it's the $170 adverse scenario now being modeled by major institutions. Look at the data coming out of Fitch Ratings and Macquarie Group. Fitch has already revised its annual average for 2026 up to $70. But that assumes the strait reopens within weeks. The deep dive tail risk report suggests that if the blockade remains effective through the end of April, the global economy faces a structural deficit of 20 million barrels per day. Under that timeline, Macquarie is forecasting a parabolic move to $150 or even $170 per barrel. This isn't just speculation, it is the mathematical reality. Even the historically conservative analysts at Goldman Sachs are sounding the alarm. They just hiked their Brent forecast to $85, noting an $18 geopolitical risk premium that is now permanently embedded in every single trade. But Goldman also warned of the largest OECD inventory draw. We are burning through our reserves at an unsustainable rate. This is a supply shock, not a demand surge. In a demand surge, the economy is humming. In a supply shock like this, the economy is choking. As we transition into the next segment, remember this. Oil is the master input. When the cost of moving a truck or running a tractor doubles, the price of everything else, especially the food on your table, is about to explode. If you thought $170 oil was the peak of the crisis, you haven't looked at the chemical plants. Fertilizer isn't just dirt or supplemental nutrients. In the modern industrial economy, fertilizer is quite literally transformed natural gas. As the conflict in the Persian Gulf escalates, the price of liquefied natural gas has decoupled from all historical norms. Because natural gas accounts for nearly 80% of the variable cost of synthesizing ammonia, the agricultural foundation of the planet is cracking. In just the last 3 weeks of March 26, global urea prices, the gold standard for nitrogen-based fertilizer, have jumped 28%. We have to break down the cost of corn to understand why your grocery bill is about to undergo a structural shift. Farming is a game of razor-thin margins and massive upfront capital. In 25, fertilizer was 30% of a farmer's total operating costs. But as we enter the midpoint of 2026, that input ratio has been completely blown apart. In the current market, fertilizer now accounts for up to 45% of every dollar spent to put a seed in the ground. This is the invisibility tax that most urban consumers never see until the bread disappears from the shelf. Let's look at the 44% metric. This isn't a theoretical projection, it is a boots-on-the-ground reality. In the American Southeast and the Midwest grain belts, farmers are reporting a total input bill increase of exactly 40 to 44%. When you combine the surge in diesel for tractors with the move in anhydrous ammonia, the math for the independent farmer stops working. We are witnessing the silent killer of the global supply chain. If the farmer cannot afford to fertilize, the world does not eat. Major exporters in the Middle East and North Africa have halted shipments to prioritize domestic food security, further tightening the global noose. This isn't just a local issue. It is a systemic failure of the just-in-time delivery model and a breakdown of the global food balance. Now we will look at the perfect storm where energy prices and fertilizer costs collide to create the most significant food crisis. We have reached the point of no return, the perfect storm. To understand the gravity of 2026, we must contrast it with the 2022 shocks. Back then, the world faced a breadbasket crisis, a localized disruption of grain exports. Today, we are facing an energy input crisis that is truly global. When the cost of energy and fertilizer spikes simultaneously, every single calorie produced on Earth becomes more expensive. This isn't just a price hike at your local supermarket. It is a fundamental shift in the global caloric balance. The hunger math provided by the World Food Program is chilling. They are now projecting an additional 45 million people will move into the category of acute hunger this year alone. This brings the total number of people at risk to a staggering 318 million. We are seeing a regional collapse. Import-dependent nations simply cannot compete for high-priced shipments. Countries like Sudan, Nigeria, and the Democratic Republic of the Congo are the first to break when the cost of shipping via the Red Sea or the Strait of Hormuz doubles overnight. In these regions, food isn't just expensive, it is becoming unavailable. The just-in-time delivery model has been replaced by hoarding. Governments are beginning to ban exports of rice, wheat, and sugar to protect their own populations, which only accelerates the death spiral. This is the ripple effect of that $170 oil and the 44% fertilizer spike we discussed. You cannot decouple the cost of a plate of food from the cost of the gas used to grow it and the diesel used to move it. As the caloric deficit grows, social unrest follows. History shows us that when the price of bread rises by more than 20%, in a single quarter, the political stability of developing nations begins to evaporate. We are tracking a 35% increase. We are tracking a 35% increase in global food staples since the February 28th attacks. So, where does this leave you? We have seen gold hit the floor while energy hit the ceiling. This is what we call the dangerous mix. Historically, when gold and oil rise in tandem, it is a flashing red light for systemic fragility. The correction in gold to $4,300 is a gift for those looking for wealth preservation before the next leg begins. The action strategy is simple but difficult to execute. You must differentiate between speculation and preservation. As the food crisis intensifies, tangible assets, physical gold, energy producers, and agricultural land will be the only things left standing when paper wealth evaporates. The floor for gold is made of paper, but the ceiling for oil is made of fire. The window to prepare for the great convergence of 2026 is closing. Watch the $4,528 level on gold and the $120 breakout on Brent. Those are your signals. The storm is no longer coming. It is already here. Stay sharp, stay hedged, and I will see you in the next update.